Hello, and thank you so much for joining me this afternoon. Thank you also FX Street for hosting us on yet another webinar, where we will be explaining the concept of scalability. Before we get into the meat of it, let me briefly introduce myself. My name is Juan, and I am a co-founder with DarwinX. And at DarwinX, one of the things we do is pair investors with trading strategies. So scalability is a topic very close to our hearts and one that is very often overlooked. So to get into the meaning of what does actually scalability mean? Well, a lot of traders, and this is normal given they're just trading their own capital, focus on making the most return they can for a given, which is their capital. So on this basis, there are a lot of people who are just hoping to make, say, 100% per year on their own $20,000 account by scalping some price feeds by brokers. And this is all good because, of course, that's all that matters when you're just thinking of managing your own personal capital. However, there's a point which is very important, and that is that if at some point you want to make a living as a trader by managing more money than your own, by, say, thinking of a business model where you manage, say, 10 million investor capital, and you get a share in the success that you obtain by trading those 10 million, then another element enters the equation, and that is scalability. And that's because not all strategies scale in the same way. It could be that, for instance, a scalping strategy is very good to grow $10,000 into $20,000 and perhaps even $20,000 to $40,000 over a couple of years. But the problem is that at some point, when you're reaching higher and higher trade sizes, you're starting to move the market because you're exhausting the available market depth. So just to highlight the concept, I'm going to show you the market depth available right now through our prime broker on the euro dollar. Can everybody confirm that they see my screen right now? It should be a price feed. Sorry, just going to simplify this a bit. Apologies for this. If you guys can confirm, yes, you can see the market depth. Thanks for that. So what you see there is that there's not one, but several prices in here for the euro dollar. At the top, you see the TOB, shorthand for top of book, which is highlighting the spread you get if you're trading something below kind of 5 lots in the small sizes. Now, as you go forward in the book, you can see that if you were, instead of sending 5 lots, you were sending 100 lots to the market, the spread would no longer be, say, 0.2 as it is here, 0.3, but it would be more like 0.4, 0.5. And that is because if we take and this is the weighted average spread. So if you sent 10 million to the market, the weighted spread would be 0.3, 0.4, which is pretty much half a pip broader than it is if you're just trading at the top of book. More importantly, if you look at the marginal spread, what you're having at kind of below there, you can see that it's kind of opening up to 1 pip, if not more, as you go down the curve. And this matters because it's basically telling you that the last dollar of assets under management is making a far worse return than the first one, and it gets to a point where the difference in return is so big that managing more euros actually eats into your absolute profits, and that is the point at which you have exhausted your scalability. Put another word, once you get to that point with the strategy, then you can't really grow any more money than you've got, and you're going to have trouble making profits going forward. And that's what we mean by scalability. It's not the same thing to grow $10,000 than it is to grow 10 million. There are actually two different ball games. When you're trading size, the game changes. And that, as I hopefully highlighted now, is because assets under management, AUM, deplete the available liquidity. Everybody is fishing for the same market depth, and a rival good. So if I eat the market depth, you can't eat it, and vice versa. And this makes every marginal investor trade at a worse price. Now, you're probably now wondering, okay, well, that's fantastic, and it's a great exercise in theory, but how do I actually know how scalable my strategy is? How can I tell a scalable from a non-scalable strategy? Well, that's the one thing we're going to discuss in a while, but hopefully before that, this is one of the core lessons for today. If you want to be investable, you want to make a living by managing investor money, to be a consistent trader is a nice to have, a fantastic quality to have, and a necessary one, but it's not the only one. So for you to attract investor money, you'll have to prove to investors that your strategy is not only consistent, but also scalable. Now, obviously, this is a question of investor slippage, so it's the investors who suffer the slippage. So let's look into the causes of what could drive that. So the first one is, of course, the trading style. So if you're trading for days at a time, then you're much more likely to be scalable than you are if you're trading for minutes at a time, because, of course, you will be achieving much higher average trade level P&Ls when you stay in trades for days than you do by staying in trades for minutes, and that's simply because the market moves a lot more in 5 days than it moves in 5 minutes. Second one is, of course, market conditions. There are times when there's very ample liquidity and there's a lot of people willing to take the other side of your trade. At those situations, it's not a problem to send kind of 20 million clips and still get filled, no problem. But then, of course, if you're going for very, very volatile market conditions, or you trade at very volatile market times, such as non-farm payroll or what have you, there's no real liquidity at those times. And even if you make a killing in terms of percentage, it's very, very unlikely that you could have 10 millions of investor money tracking you make a killing because we want to find lots of investors to back the traders that trade them through our broker. So we have invested a lot of time into. So there's a question here saying that. So there's a very good question from Jack Sang. So it is true that a lot of people think that the FX market is way too liquid, and yes, it is true that it is one of the most liquid markets in the world, but unfortunately, it is not infinitely liquid. There are well, of course, liquidity changes across assets. So one thing is to trade the euro dollar, another thing is to trade some exotic currencies. There's a lot more liquidities in the euro dollar in the top majors than there is in the minors. And also, as I said, it is liquid, but it is not infinitely liquid, as you can hopefully see from the market depth. This is basically telling you that there's 50 million of liquidity at any point in time that you can access through most prime brokers, but the spread that you have at the bottom of that is already in the range of the kind of pretty much approaching 1.5 pips, even at times of extreme liquidity like you have now. So you can see the top of book now is pretty much choice, so zero spread. But if you want to trade a trade with 50 million, then you're going to move the market by one pip or 1.5 pips by exhausting the market depth. And if you're trading 10 million assets under management with 5-to-1 leverage, which is not that much in terms of risk, then yes, you would be moving the market. It's actually like that. Yeah, of course, you could look into fractioning the trade and perhaps sending 10 million, then 10 million, then 10 million, and so on. And that's one thing that's obviously an option. But the fact is, you can't send 1 trillion and expect that the market is not going to move. So that's another very good point by Anis. This is the liquidity you see with one prime broker. So the liquidity in the overall market should be huge. Yes and no. So the way the FX market works is by aggregating the liquidity from different competing sources. And yes, you're right that there's a ton of prime brokers, but unfortunately, it's not like they're all going to different banks. So the underlying liquidity providers are about the top 15 to 20 banks in the world, and those are the ones that are making the most of the liquidity in the market at any point in time. And all the prime brokers are doing is connecting people to those underlying 15 to 20 banks plus a bunch of non-banks and so on. But it's not, to say that you have like 20 prime brokers have 20 times the liquidity as one prime broker. I wish that was true. I would love that for that to be true, but it's not. Ultimately, you're trading against the top kind of 15, 20 banks, regardless of where you access from that. So I reckon, I wouldn't say this is all the liquidity that's available in the market, but there's a lot of, I reckon most of it is here already. There's, as I said, FX is very, very liquid because you could be trading at a 50 million in a couple of minutes and so on. But well, Anis, yeah. So Anis's point is that this is not the whole representative of the whole FX market. Let me put it this way: I think it is actually. I really think it is, because one thing is what people are saying. The other thing is what happens when you start going to the market and you do hit limits. The other thing to bear in mind, as I've discussed in other webinars, is that the Forex market is an over-the-counter market, which means there's no centralized order book. And you're really tapping into each of the individual providers individually. And it could be that at some point that other party chooses not to trade with you. So even if there is liquidity there, then you're with that. So I apologize to those of you who think that we're kind of moving away from the core topic, but I thought this was an interesting side point because it really is an important one about scalability. The scalability is really a question of how big you are as a contrast to the rest of the market. And what you're seeing here is, in my humble opinion, as a CEO of a broker, this is a representative sample of what you can trade in the Forex market right now. Again, so somebody's saying Reuters centralizes most of Eurodollar orders. Yes, Reuters does that, but Reuters does not have a balance sheet. It's the balance sheet of the kind of 15, 20, 25 top banks. So there's a lot of people aggregating liquidity, but it's coming from the same sources. It's not like there are 50 banks in every country that are doing liquidity in FX. So I'll be happy to take more questions on this when we go along the presentation, and thank you for challenging here because it's an interesting one. But from now on, we're now going to discuss a framework to assess the scalability of a strategy. So we look at this from two standpoints. The first one is how likely is it that an investor tracking a strategy would experience slippage, so the probability. And the other one is, of course, the impact. So if it was to happen, how bad would it be? Because obviously one thing is to suffer 0.2 slippage, and another thing is to suffer 20 pips slippage. So there are two different order games. So let's get going with the, so what is a scalable strategy? Well, obviously a strategy that's scalable will have low sensitivity to the slippage, and the slippage will be unlikely to begin with. So to look at both in the same way. So if you're going to trade the euro-dollar at times when there's ample liquidity, that's going to be much better than trading an exotic pair during a release by its own central bank of news. So that's to reduce it to the observed. That's what happens. So on the first of the 2 points, so how likely is slippage to occur? Again, I kind of took away some of my thunder. First of all, is going to be the volatility of the underlying asset. So if the asset is not very volatile, then you have a good choice at being able to place a lot of volume without too much movement in the price. And that's because it will be liquid, which is the second point. And last but not least, you can also play by, and this is something that we're kind of experiencing right now with RNX. It's not smart once you're trading big sizes to send all the volume to the market in one block. So there are all sorts of algorithms to basically break up the volume of an order into smaller pieces and make sure that you place things in a price more advantageous to your investors than it would be by just dumping the whole thing in one go and exhausting the market depth. So as I said, those are the 3 points. And this is what you can see. And now we're going to go. This is a chart that comes from Darmneck. So there's a lot of experienced traders basically ask you, do you trade pips or size. And what they're basically implying is how leveraged are you when you trade. If you trade size, that basically means you're going for small movements in the market price, a couple of pips, and you're amplifying the P&L by leveraging yourself by a lot, like say 20, 30, 40 to 1 for a short amount of time. That would be trading volume. The other option would be to basically say, I'm just going to go into trades for days at a time without much leverage, because ultimately I know there's going to be a P&L of hundreds of pips for me to be made by staying in the market for long enough. So I don't need the leverage in the first place. So how do we look at this at Darwin X? Well, we have a bunch of grades in here. I'm just going to show you a couple of strategies, one of which is scalable and one which isn't so much. So I'm just going to look for an example of a scalable strategy. As you can see here, this we're giving it a 9 out of 10. By the way, if any of you guys wants to have a personalized diagnostic of any of this, we do this entirely for free if you're trading with any MT4 broker. So you would get these grades from us. And we even have a service where an expert trader would explain to you how your grades come about. But so let's go into the track record of this strategy, which has a 9 out of 10 in scalability. And let's just focus on for a period on in the trading history. So as you can see, the shortest trades in here are done for almost a day at a time. So there are trades in here that have lasted about 10 days. There are some trades in here, yes, there are some short ones, granted, where they were like 10 hours. But obviously, these are reasonably long trades, so you can expect that there'll be reasonably large fluctuations in the market in that horizon, and therefore you don't need to send large ticket sizes to the market. So we're going to look at our assessment for scalability here, and what this is telling you is for every million assets under management by this strategy, it is triggering a trade size of 0.8 million. So it's pretty much 1-to-1 leverage, meaning that you could get to about 8, 10, 15 million of assets under management per trade without disrupting the market too much. Because as we've seen, from about 10 million is where you really hit a cliff in terms of the liquidity. So much for a scalable strategy in the sense that it's not leveraging too much the investor volume assets under management, and therefore it can afford to have much more assets under management. Contrast that with another pretty consistent strategy, which we're going to see here, but that has a scalability score of 3.4. Again, you can see it's a fantastic track record. But if we go into the trading journal of it, so the track record of the strategy, just going to take a bit of time because we have quite a bit of history here. You can already see that the trades here are much shorter, so I'm just going to focus in on a time frame here. And you can see here, okay, so there are some trades which have lasted for a kind of 4 or 5 hours, but there are also some trades which are in here for about half an hour. And or even 20 minutes or even 21 minutes. And that's a much shorter time frame, meaning that the market is going to move much less in that horizon. Therefore, rather than kind of profit from the natural move in the market, what you have to do is leverage. So if we go to their scalability assessment, we see that, remember, we had 0.8 million per trade for every million of investor monies before. Now we've got about 2 to 3 times the size per same million of investors assets under management, which means all other things equal, this is much more leveraged and is likely to scale less well. So that's so much for the probability of scaling. Okay, so this will have, for any given amount of assets under management on a cumulative basis, this will have traded a lot larger trade sizes, which means higher transaction costs and also higher slippage for investors. Any questions so far? Okay. So looks like we're good. So let's continue. Then, of course, one thing is the probability of slippage. The other thing is how much impact it has. So again, how do we look at it at Darwin X? Well, what we do is we look at how sensitive a track record is to this slippage. So you see, for instance, how much would have an investor made if he had been slipped systematically by 0.2 pips, 0.5, 1 pips, or 2 pips. And you can see here that with 1 pip, we're already underwater, which means it's unlikely that this strategy will ever manage more than kind of 5 million in total assets under management. And that's the kind of scalability ceiling. So we have a question here. Can we say scalability for a trader is using less leverage of capital and thereby the inherent risk as an advantage and leverage the market moves? I'm not saying one thing is better or worse. All I'm saying is how much investor, let me put it this way, if you can make 20% on 100 million assets under management, that's fantastic because you basically generate a P&L of 20 million at the end of the year. And if you're a hedge fund manager and keep 20% of that, then you've made 4 million of take-home pay, which you can then redeploy. So that's one business model. The other business model is if you have a strategy that makes 200% per year, but you can only put to work $50,000 into it, then what happens is you started the year with $50,000 and you ended the year with $150,000. But the problem is by the end of the year, you kind of have to take the $100,000 in profit because it's impossible to deploy them again in your strategy and reinvest. That's I guess the issue. So and then yes, so in terms of if you're looking for investors, it is very important that you prove that your strategy is scalable, because if you can prove that it's still making profits by managing 100 million, then you will get the 100 million. If you can't prove that you're making profits because essentially you're moving the market against yourself after $150,000, then there's no way an investor will put another million on top of it, because if you're not making any money on 150,000 anymore, then with 1 million you'll actually lose money on that strategy. So it is very, very important if you want to land the investors' money. And that's one of the topics of this webinar, is a lot of people don't realize that the market is finite and that they have to look for opportunities which are scalable. So at the risk of repeating myself. And if the market is not, if it's not scalable, this is what you would see. You're moving the market by so much against your investors that you're making money, but they're losing, and therefore they will never stick with you. So yes, so it's important to be a consistent trader that trades with a consistent strategy, with good risk management and good timing and so on. But that's not enough. That was my point there. You have to, in addition to all that, you have to find scalable strategies, because otherwise you'll never get there. So if you look at these two charts, you have one where 2 pips of slippage, or actually 1 pip of slippage at the top here, the investor is already underwater, whereas here the original strategy is making 9.6%, but it could be slipped by quite a bit and the investor would still be making money. And a large investor would very likely prefer the second strategy than the first one. So obviously you're wondering what helps the scalability. Well, you basically have to go fishing where there's a lot of fish to begin with. So it's best to trade liquid assets. And then the more liquid the times when you trade, the better. So it's much better to trade when there's no news, because the likelihood of slippage is much lower than it is by trading during news times. Actually, we see, and this is one of the lessons that a lot of traders learn with us, when you are not used to trading with a DMA broker like DarwinX, a lot of people don't realize that the spreads widen a lot during news releases, and if you have very tight stops and take profits, very likely they might get triggered if you're just sleeping a nap during non-farm payroll. Then again, there's the possibility of experiencing with a fractioned execution. So instead of sending all your trade in one go, you can look into ways, okay, what would happen if I send the first half of my trade now, waited for 5, 10, 20 seconds, and then send my second half of my trade, and so on and so forth. That could possibly help. Ines, thanks for the question. I'll come back to that in a second. A very good question, but not really so relevant to everybody. Again, why do they? I'm seeing the questions, guys. I'll continue going, and then I'll go through all of them. Just bear with me, okay? So again, fractional execution is can help, and then again, I'm not saying that having a strategy with high average P&L is better than going for a more leveraged one, but certainly it is more scalable. So it is better that to kind of stay in trades for days and look at the P&L is in the kind of tens or hundreds of pips than it is to try and leverage a 5 pip per winning trade strategy by 20 times or more, because the latter is going to hit the scalability ceiling much sooner than the former. Another point that a lot of people say, hey, I'm going to trade with less risk because that's going to improve my scalability. That actually doesn't really matter. What matters is the total volume you're sending to the market. And that really depends on the assets under management by investors if you're managing investor money. So it's not affected by how much risk you take. And yeah, that was kind of really what I had in mind for the core of the webinar today. And seeing as we've had a lot of questions here, I'm just going to go back to them, and thank you so much for all of you guys who have asked them. If you have any more, feel free to type in. I'll just get through them on a first come first serve basis. So there was a very interesting point by Jack, and he was saying, could it be that a prime broker refuses to trade with you even if you don't have a dealing desk? Can they choose not to trade with you? This is going to sound shocking to you, but the fact is, think of the market as a huge casino, right? Ultimately, people are trading against each other and providing liquidity to each other, but in a short enough time frame, my win is your loss and vice versa. So at DarwinX, for instance, we aggregate liquidity from 17 liquidity providers, and we have had 1 or 2 choose not to provide us liquidity or widen the spreads because they claimed we are toxic flow. Toxic flow is a very, very polite way of saying that given the choice between catering to a lot of retail traders who lose money and therefore, because I'm taking the other side of the trades, make me money, and picking against traders who win money, I prefer to go with the losers because that way I win. So unfortunately, that is the case. There are, and I could even show you examples of that. So if you go to the LMAX exchange, which is one of our providers, there's a flow that's designed for retail traders who lose on average, and that is a very tight spreads. If you go for the more algorithmic flow where you can kind of have no restrictions, then the spreads widen because the LPs are not willing to provide such narrow spreads when they're trading against winners. So that's one there. Then there was a point about, so Diego's point saying that Reuters centralizes most of Eurodollar orders. The way the Forex market works, and I had a webinar on this that you can look up on my Forex Street profile, is there are, as I said, 15, 20, 25 banks, and then a bunch of non-banks who are providing liquidity. And there are a lot of aggregators who essentially gather the best price available from all those banks and then offer it as if it was like another source of liquidity, but really there's no actual liquidity added by having more people aggregating because they're all aggregating from the same place. So Reuters is just an aggregator. It doesn't have its own balance sheet. And that comes back also to the other point by Anis saying that this is not representative of the whole FX market. And yeah, my response to that is that you can aggregate the same 15 or 20 guys in the 15 or 20 different venues, but ultimately you're still aggregating the same 15 or 20 guys. So it's not like it's unlimited liquidity at any given point in time. So a question by Anis: does DarwinX intend to provide automated tools to use to actually become better? And the answer is very much so. We are already working on those, and they will be released gradually throughout of next year. So we plan to offer tools for traders to manage risk better, and also for them to manage the scalability of the strategies better. That is coming. Then there is a point about related to liquidity, and so there's people saying why are spreads reduced why spreads wider at news times. That's one point, and the other one is when markets in close, say in London, and liquidity will be reduced, and the answer is yes, it will be. And for you to understand why that comes about, it's the same answer in both cases. Really, what's going on is you're taking limit orders on both sides of the spread, on the bid and the ask, and there's a lot of people kind of saying, I'm putting a limit order for kind of 100 lots at this price on the bid and 100 lots at that price on the ask. That's what a liquidity provider would do. If you have a lot of liquidity providers competing to hit your trade at the same time, then you will have a lot of market depth, which means the jumps in the order book are going to be narrower, which means the spreads will be tighter. But then, of course, if a lot of those guys withdraw because either the market has closed or because there's a lot of volatility expected, then the spreads widen a lot, and also the slippage becomes a lot worse because the book is a lot thinner. So in that situation, what happens then is that the spreads widen, and that's how it works. So the price is just the result of the order matching, and the order matching really depends on the density of the order book. If there's a lot of volume that's competing for the orders, then it's very narrow spreads. But if there's very little volume, then the spreads widen a lot. So that's how organized markets work. It's people competing for the trades to be hit. So yeah, on that basis, that's actually the reason why scalability matters. If you took it to the absurd and there was infinite liquidity at all times, then every strategy would be infinitely scalable, and we wouldn't be having this webinar. Some of you are asking what the slippage here is. Well, the slippage is, if you look at the top of the order book, you can see that the bid and the ask are closer than they are at the bottom of the order book. And that's the reason. So and the reason why that is that, as I said, because there's not everybody is willing to provide infinite liquidity at a given price because the market moves. That's the thing. The price moves as a result of the flows, not vice versa. Okay. So it looks, yeah, like we've covered most of the questions that you guys had. If you had any follow-up questions, I would be delighted to just, if you could email me, my personal email address, I can write here, is juan@darwinx.com. And I'd be delighted to give you, to hold more webinars on topics that you deem of interest. Also, we have a YouTube channel that you can check out. So if you check out YouTube DarwinX, just by Google that, you'll find all the webinars that I've ever held with FX Street, and also our own homepage are there. So there's quite a bit of ground that we've already covered in those. But unless you have any more questions, all that remains is for me to thank you for your time and your interest on this Friday afternoon. It's always a pleasure to have you guys on board. I don't know if some of you guys were attending this webinar, which was scheduled to be held on Monday. Unfortunately, I had a personal issue and I couldn't give it then. So my apologies in person now for being 4 days late for this one. Okay. So yeah, that was pretty much it. And thank you so much. It's always a pleasure. As I said, if you have any questions, we'll be talking about it. Take care and speak soon. Bye-bye.